Welcome back to How I Franchise This, the show where we unpack the real stories behind franchise empires. Today's guest is Cal Gulapali, and he got his start serving hot and readies at a Little Caesars. He worked on a Wall Street prop desk, he bought butcher shops and pizzerias, and has overseen 140 franchise locations across 10 different brands, including some of the hottest names in the game, like Dave's Hot Chicken, Marco's Pizza, Orange Theory, and Pop-Up Bagels. In this episode, we dive into how he raised capital for major rollouts and the exact financing structures that took him from two Orange Theory studios to an over 100 plus unit portfolio in just 8 years, and what he looks for when scouting the next breakout brand. If you're serious about scaling your franchise footprint, this one is a must listen. All right. Well, appreciate you coming on the show today, Cal. I'm excited to dig into your background, your franchise journey, and really just learn soup to nuts what it's been like from, zero locations pre-franchising all the way to, where you are now. So welcome.
Yeah, thanks for having me, Alex. Look forward to a good discussion.
Yeah, let's start all the way. Well, I guess let's give folks a quick overview on kind of where you are today. I think it'll set the stage for, holy holy cow, how did you go from nothing to where you are now? Walk us through, a quick overview of what MPZ Holdings is and what your current portfolio looks like.
Yeah, so there's actually a company above MPZ Holdings called Simple Ventures. That's kind of my holding company, which owns MPZ Holdings. But Simple Ventures was created in 2017 when we first jumped into franchising via OrangeTheory Fitness. Subsequent to that, we've been in about 10 different brands, food and non-food, and it's been a really fun journey. So, on the food side, for example, we're in Marco's Pizza, Dave's Hot Chicken, and Pop-Up Bagel, which we haven't opened yet, but our first one opens up in end of August. And then on the non-food side, currently, we're in VO Med Spa, Restore Hyper Wellness, Hand and Stone Massage, and a concept called Sandbox VR. And we've exited two brands, OrangeTheory Fitness and European Wax Center.
At the height of total locations, and maybe that's today, how many just sheer locations do you have open or have you had opened across the portfolio?
Yeah, I mean, when we sell, we generally have maintain some maybe small equity portion. So I do have some rollover. So if you kind of consider all of those, we're about 140 locations. But if you kind of just bifurcate the active locations, we're around 80 right now.
That's absolutely incredible. So for those listening, if you think about it, Cal was saying he formed his entity, you said in 2017, right?
Mm-hmm.
Yeah. So in 8 years, you've grown this portfolio and grown this business to, at some level, 140 different locations. I think what people would be interested in hearing more about is what were you doing before this? Like, and the origin story of, why franchising and how you go from, again, zero to 140. What was life like before franchising?
Yeah, sure. So I grew up in Michigan, a little bit, about 30 minutes outside Detroit. And my first job was Little Caesars. So it was, I started kind of in franchising and as an hourly. And I loved the job. I loved working hard. I loved the fact that after 3 weeks, I became assistant manager and just given responsibility at the age of kind of 17, 18. I took it really seriously, probably more serious than most. And that just kind of started my dream of multi-unit. I mean, at that point, I was thinking, hey, why can't I own many of these? But I went to college, and after college, I worked on Wall Street for about 7 years at Merrill Lynch, both in investment banking for 2 years, and then 5 years on the internal prop desk at Merrill Lynch. And so we took Merrill Lynch's capital and invested into mostly debt instruments, but a little bit of equity as well. So, but really over those 7 years, I was really learning about valuations, whether it be at the investment banking side or on the prop desk side. But my mind was always in small business, even those days. I would always be on Biz Buy Sell or BizQuest looking for a business to buy, but just didn't have the guts at that point to, take the leap.
Where do you think that interest came from? Do you think it was from your early experience working in small businesses, or where do you think that, I guess, interest stems from?
I've always, even though I had like the greatest bosses on Wall Street, I never really enjoyed the work. I think internally I'm wired as a entrepreneur. I like all the pressure on myself, and I like building teams. And so in a Wall Street environment, yeah, the money's great, but you don't get the autonomy to build what you want to build unless you're at a very senior level. But even then, there's a lot of bureaucracy, right? You have to get approvals from there's always someone ahead of you. And I just didn't love all the political, games that you'd have to play to get to where you want to be.
No, I think I was the same way. I was at EY for a year and a half, and that's all I lasted was a year and a half before going to go start my own thing. So I get it. The upside is uncapped, and the fulfillment you have, doing your own thing. It can't be beaten. I don't think it can be replaced in a corporate setting. Okay, so you're on Wall Street. You're doing some your private equity. You're learning how to evaluate businesses. When did the moment come where you said, "Hey, it's time to go do my own thing"? And I guess walk us through that thought process and how you even started looking for the right thing. Was it immediately franchising? Was it other independent businesses? How are you looking at things?
Yeah. So when Merrill Lynch was acquired, or maybe forced to be acquired by Bank of America, um, we were one of the businesses that had to be shut down. We were taking tremendous risk, and that was a time when the Fed wanted or the Treasury Department wanted banks to take very little risk, and so we got the mandate to say, "Hey, you have 2 years to unwind this book." So I did have a role there for another couple of years, but um, my boss and I kind of left to start a hedge fund. But if you remember back then, the capital raising environment was terrible. So we raised a good amount of money, but it wasn't enough to really stay there. And I was like, "Hey, I think this is the time. This is the time for me to kind of venture out." So I started actually a franchise review website, and it didn't take off. I didn't really know much about how to acquire customers on the internet, and it really was in over my head. So
What was it called? I didn't know this part. What was it
yeah,
called?
yeah. It started as Franchise Hound. It was a blog that turned into a company called Small Bizio, and Bizeo, and we literally reviewed every single, like almost like the equity research mentality of franchising, of Wall Street. We took that to reviewing franchising, and we would give grades like A, B, C, D. And we'd look at store counts and all this stuff, and we weren't turning, and most of the franchise websites are lead generation websites to generate the revenue. That's how you make money. But we were eventually trying to create a revenue model where people would pay for the research. But I didn't realize that the prospective franchisee community does not want to pay for that. Or we didn't have enough value prop for them to pay for it. It's probably a combination of both.
Interesting. I didn't realize you were doing that. Have you since seen like Franchise Business Review or FBR and like what some of those companies are doing today?
Yeah, I mean, as a franchisee, and obviously we'll get to that story, but there's so much information out there already that now I realize, like, I don't know that I'll pay for it, right? So I learned that there's, the best way to get information is just to talk to existing franchisees, and that is really the most valuable way to vet a franchise out, in my opinion.
Yeah, just talk to people who have done it and see if they do it again. I mean, I completely agree. We're constantly trying to find ways to incorporate that into Franzi and what we're doing there. Okay, sorry for the digression. I had no idea you were doing that review site. So okay, so that's how you started. I guess what gave you the idea for that? I mean, again, you're doing Wall Street business valuations. Why a franchise review site? I mean, where did that idea come from?
Yeah, I mean, I think there's two different things. One is, I had the background of always talking to equity research and debt research analysts on Wall Street. And during that like kind of 7-year career on Wall Street, I was constantly looking for a business to buy. And so I'm like, "Hey, how come this doesn't exist? How come there's no," and this is again back in 2010. And I'm like, why isn't there a portal where we can learn more about franchising? And I know to really strong extent, you guys are solving for that. You're just making more, you're creating more transparency in the FDD, amongst other things. But we tried to do something along those lines back in 2010. But uh, again, I wasn't an internet person, nor did I know much about it. So I was almost setting my own self up for failure.
Okay, so you do that for some period of time, and then what? What was after that?
So I jumped into independent businesses first. I still didn't know the value prop of franchising at that point. Like I knew what it was, I knew that people were doing well, but I didn't understand like why would I pay this royalty stream, right? So I bought a butcher shop in Long Island, a long-standing like 70-year-old butcher shop, Italian butcher shop in Long Island. Took it over, became an intermediate butcher. I worked there like 6 days a week. It was closed Sunday. I bought another one in Long Island in New Hyde Park. So the first one is in Malvern, New York. Second one was in New Hyde Park. And then we sold maybe 3 years later. And really fun experience. It was like my first like foray into leadership. And most of the folks that I was leading were 20, 30 years older than me. So it was challenging, made a lot of mistakes, but learned from them. And so my wife at that point finished business school and we moved up to Boston because she took a job at a corporation up there. Um, in which case I still stayed away from franchising. I bought a high volume independent pizzeria in a town called Woburn, Massachusetts. It's about 10 miles north of Boston. And then we opened up a burger joint loosely based off Shake Shack across the street. And both did extraordinarily well. And I owned them for probably 3 to 5 years total. And in 2016, I became a member at OrangeTheory Fitness. And I've always been very curious. And so, I met the owner, who's actually a business partner of mine now, and I just grilled him. Like every single time I went to the gym, to the fitness facility to go get a workout in, I would sit down with him for 15, 20, 30 minutes and just grill him. And eventually he was showing me his P&Ls, and I'm like, whoa, this is crazy. You can make this kind of, you can get this kind of return at an Orange Theory Fitness. And so we went down the route of meeting with the area representative who's local in Boston and secured just 2 licenses. And so we opened up 2 in 2017. And, that's kind of our start to our growth path.
Did you do those first two with the owner of the gym that you met just in your conversation?
No, that was 100% our own family. My wife and I were both in the business at that point, and he was I would say more of an advisor, kind of helping us get into the brand, and then our peer, I guess.
When you're so the reason I'm thinking about this is I was a finance background, finance major from Wake, and did some of the consulting. I can just imagine you look at like the butcher shop business or the pizzeria and like doing this hardcore discounted cash flow analysis and like running crazy. Is that what you did, or did you take a more, hey, these are kind of going to be more handshake type deals, or did you run like your private equity investment banking playbook,
Yeah,
on those deals?
I've sold companies to private equity, and I'm not as hardcore as as those guys. I mean, we'll get into stories about that later, but um, I'm I'm a little bit in between, where I'm less private equity, more handshake, but not like truly. I mean, I still need everything papered and under my lawyer, but so I would say I'm more of a hybrid between the two.
Nice. Yeah, I was just picturing because with that kind of training, I feel like it's easy to get into like, hey, I have all these tools now and I know how to look at things in a at a different level. So I was just curious about
I
that.
mean, just imagine buying a butcher shop from, a 65-year-old butcher that's been in the business for like 45 years, and you take a private equity approach to buying it. You probably will never get the deal done.
Oh,
Yeah.
we're like, who's this guy who's got like a 60 tab spreadsheet and okay, so that's how you got into franchising. You became a member at Orange Theory. You start to look at the numbers. You're like, wow, there's actually something here, even with the 6% royalty or whatever the royalty may be. It's still worthwhile. So you get 2 units open. Did you and your wife ever think like, hey, this is gonna go from 2 to 140, or what was the goal? Or were you guys just like, hey, let's test a couple out and see how it goes? Or what were the ambitions on day one when you get into those first 2 licenses?
Yeah, we were not thinking that big back then. But what happened was when we sold in kind of we're starting the process of selling in 2019, because Orange Theory at that point was we jumped into Orange Theory in the seventh inning when most of the territory was taken and people were just kind of filling their development agreements. And once we got to the point where, hey, you can sell these for like 7.5x, or you can buy people out at that, we're like, hey, we're not capitalized to buy people at those levels, nor do we have the confidence to do it. So we sold to the largest franchisee at that point. I think he had 100. And at that point, it triggered me. I'm like, man, if he can do it, I can do it, you know?
Yeah.
And that's when we really took off.
I love that. So it's like the whole, show me who your closest friends are, who you're surrounded by, and I'll tell you who you are. I think the more you continue to be around folks like that had the 100, that had the 80, it gives you these new ideas of shit. Maybe I wasn't thinking big enough to begin with.
Yeah, absolutely.
Okay, so you had those two. I mean, and now you're in some of the the buzziest brands in franchising, Dave's Hot Chicken, Pop Up, Marco's, etc. How did you start to due diligence and I feel like you have a good picker. I mean, what tricks or tips do you have for identifying good brands or good opportunities?
Yeah, I think very similar to the Orange Theory days. It's getting to know, you know, talking to a handful of people, like not five, probably 10 to 15, maybe 10 to 15 franchisees in different markets, and understanding, hey, what's making a good location? How much are you actually making? Can you show me your P&L? How is the franchise supporting you or not supporting you? And really asking every single question. I would say, and this is just me throwing a number out, but I would say 65% plus of the franchisee community are very open to sharing data and qualitative information on the franchise brand. So most folks need to be utilizing that to get as much information as possible. And look, there's tremendous information in the FDD, and that's kind of phase one is just kind of going through the FDD and understanding store counts and growth, and where is the brand growing, where to start, how, item 19, how is the existing brand actually doing, and then phase two is really getting into what are the nuanced pros and cons of this particular brand and how are they really doing it? Because the franchisor can tell you X, Y, and Z, but that may not be actually the case.
You bring up a really, really good point that I don't think enough people do, whether it's franchising, validation and talking to the franchisees, or just getting help from mentors or other entrepreneurs in general. I have found that if you reach out to people thoughtfully and you're being serious about yourself and you're serious about their time, and it's really just to truly improve yourself and to learn something, 9 times out of 10, someone before you is going to take that time and give you the feedback, give you the advice, because someone did it for them. I mean, even look at you jumping on calls with Dan and I, or doing this podcast, is like people will take the time to help others because it's so important to fill that cycle of virtuousness, I'd say, because someone did it for you at some point. And I don't think people take advantage of that enough, or thoughtfully reach out like that with some of those seemingly tough questions.
Yeah, I think a lot of people are willing to help. I think sometimes, like, this is what I think happens sometimes. I haven't validated this, but if you're like going into a brand and it's like, you have you're really like passionate about the brand and you really want to join, sometimes prospective franchisees don't want to hear that the brand is actually not good, so they won't go to the validation process because they're so already bought in.
That's a good point too.
And
It's like,
I'll give you an example. Like Orange Theory in Boston was to the point of saturation, right? They opened so many locations and they were starting to sell tier 3 sites. Okay, and if there's been a couple times this happened, but I vividly remember Orange Theory. There was a franchisee who went into a tier 3 site literally 6 miles away from us. And this franchisee never, ever called us. And he could have easily said, hey, I'm thinking about opening here, but he's maybe scared that we'll take the territory. We weren't going to do it regardless because it was a tier 3 site. And he could have asked, like, hey, how is your we were in Westford, Massachusetts. How's your Westford studio doing? And we would have given him the data, and we would have told him our opinions on the site that he was going to select. And it may have swayed him or not, but at least he had the information to do it. But he never, ever reached out. But post the fact that he signed it, he closed within like 2 or 3 years and lost a lot of money. But I think sometimes they're scared for two reasons. One, they're like, oh, Cal may take the site. That could be a valid concern. That probably happens. It does happen a lot. But the second side is, hey, maybe I should talk to this person to understand how is the existing site doing, and can that small geography actually handle too?
Mm-hmm. That's a really good point. It's, and again, not even just specific to franchising, anything in life when you're just blinders are on, you've got rose-colored glasses, and you're like, I don't want anyone to tell me anything
Yeah.
I don't want to hear because my mind's been made. But you have to have, it's a really good reminder to have discipline. Like, don't get emotionally attached to something. It's business at the end of the day, and you got to make sure it's a good idea to pursue. I think that's super helpful. So when you were talking about, doing diligence, and again, you've picked a lot of really good concepts, really good brands. It sounds like a huge part of your diligence is talking to other owners, looking at the numbers, looking at the data that's out there. Are there any like really big, clear green flags or red flags when you are doing this diligence and doing this process that you look for?
Yeah, I think, when I jumped back into food, like first time franchise food, but I've been in food in the past. Like this is back in 2020 or 2021 when I jumped into Marco's. I think it was important that we joined brands that were very digitally focused, because if you remember back in 2020 and 2021, Chipotle, Domino's, these guys were all investing, I don't know the number, but millions and millions into the digital infrastructure, right?
Mhm.
And if you're a food company, you had to do that. And so besides the franchisee validation and our view on the brand for the next 5-10 years, and their real estate company, their real estate prowess, to the franchisor's willingness to help you to find great real estate, I think that's that last part that maybe other folks don't look in as much, is how tech forward is the company, like how good are they going to be, not only on the digital side but also the experience, right? Are they going to be good at the online ordering experience, the mobile app, and making sure that they have a great loyalty program? Like all that stuff combined is just so important, and you don't want to be behind the curve.
You brought up something, or you reminded me of something else. How much are you looking at things like robotics too, like robotics, cooking food or prepping things? Is that come into play yet, or do you think we're still a few years away from that?
I think we're a few years away, from even on the franchisee side thinking about it. You do want your franchisor to be looking at, hey, how do we automate certain tasks so that we're ahead of the game, and we should, like, the franchisor, I think, should be testing this stuff in corporate stores. Um, but from a franchisee perspective, we just want to know that they're thinking about it. I'll say this, I'm not.
Yeah, yeah. No, that's fair. Okay, so green flags are, good validation, good economics. Hey, there's tech forward thought and an investment being made here. What are some of the red flags where if you see even, you might see all these other positive signs. If you see one of these red flags that you're just like, absolutely out, you got to avoid things like this when you see it.
Yeah, this is hard to gauge, but the one thing that I've seen really differentiate good and bad franchisors is, like, the good ones are maniacally, I mean, obsessively focused on franchisee profitability. Like
Mm.
when you look at the Daves folks, like when they write an email to franchisees internally, literally it says how, why, what, and they're explaining, with great transparency, they're telling us why they're doing something, how they're doing it, and why they're doing it. And so, and really, how is it going to affect your bottom line? I mean, they're that intentional on how it's going to affect your bottom line. And if you're maniacally focused in franchisee profitability, you will do very, very well for both the franchisor and franchisee. Some brands, have been short-sighted, right? And they're just looking to sell franchise agreements, and not really focused on the unit economics of each individual store. Or, they're going for the money grab of, rebates, right? Um, but if your franchisees are not making money, they're not going to grow. You're going to hit some sort of stall. You can only, you can sell into the euphoric utopia of a great brand, and the demand on this one location is doing so well. But if you don't have a long-term great business model that generates cash, and a great payback period, it's going to stop at some point.
Yep, yep. That's really good feedback. So you're looking for, hey, if there isn't this culture almost of, hey, why are we all really doing this? And where is the health and underlying sound business fundamentals and profitability? We're talking about the wrong things. And so it's almost anytime they don't talk about that, that's a red flag.
Yeah.
What, so as you were, going from the two Orange Theories to, you've now signed on again, dozens of units with some of these amazing brands. Walk us through some of that, like how you went from two Orange Theories to what was the next big play? Was it five of something, or did you immediately go into 20 of something? And how did you start to experience some of that more like hockey stick type growth versus linear growth?
Yeah, so it's a couple steps. In 2018, I bought four European wax centers in Boston, and I spent about 6 to 8 months just turning those four locations around. And once I started seeing some really good success, I bought two more the next year, and then I opened a seventh that same year as well. So in 2 years, we went from a four-store acquisition to seven stores open. Um, Now what happened in 2020 is I took a private equity investment, and with my private equity partner during the years of COVID, we really expanded. So we went from those seven locations to 40 plus in like 2.5 years.
Wow.
Yeah, so it was an
All de
acquisition.
novo new units, or you're buying up those all buying up existing?
Yeah, so that portfolio is probably around 50 to 52 ish locations now, and I would say 10 ish are de novo, and
Okay.
everything else was an acquisition.
Okay. And you funded that privately through a partner through private equity investment.
Yep, yep.
And is that
Um,
where things like really started to click or change for you as far as, okay, hey, here's the path to 50, 60, 80, 100 plus is finding the right partner like this, capital partner to do this at scale?
Yeah, I think, unless you want to go, and there's nothing wrong with it, a kind of a slower route. You do if you want to get to 50, 100 units in one brand, I think it's really important that you find partners both on the equity and debt side. And the good thing about franchising is a lot of folks on both sides, whether it's equity or debt, really want exposure into this asset class. And even specifically on the debt side, there are a lot of small to medium to large debt lenders that love franchising. And so, I think we're kind of going through a traction right now in 2025 where some banks are hesitant to, throw capital into small business in general. And so franchising is getting hurt as a result. But in general, it's still a very large market of capital that's flowing into this asset class.
That's kind of, it leads up to my next question is, at this scale, how do you finance this? And it sounds like, for the European wax deal, it was private equity, but I imagine each deal is a little bit different, right? Sometimes it's debt, sometimes it's equity. Have you ever used SBA loans? I mean, walk us through how you think about financing a deal, especially at this scale.
Yeah, so usually, like if it's a smaller brand with not that much recognition yet, like if they're growing, they're mightily growing and doing a really good job. Um, SBA is really the only route if you're not 100% cash. So some of the smaller brands that my family owns, we're the only investor. Where we only have one or two or three locations, we're the only ones, and we do still use SBA. Um, while the SBA is highly, there's a lot of administrative work to get a deal across the line. It's a phenomenal program to get, a deal done. And so, even kind of at our size, 80 units or at 1.130, the SBA still is very relevant. Now, when you get to, what we were talking about before, where, you want to get to 50 locations in a brand, there are middle market lenders that we've had great relationships with, that we've used to help, create these term loans. And on top of that, delayed draw credit facility so that we can expand, whether it be through acquisition or de novo. And there's many, many banks that are looking for, great operators to deploy this type of capital in.
And so when you're in, some of the concepts that you're in that are say sub 5 units, that's when you'll say, hey, let's use the SBA lever. And remind me, can you use up to, is it 5 million per concept, or is it per individual that the SBA starts to cap you out on?
Yes, I believe, and should double check this with
Yeah,
ChatGPT,
yeah.
but I think it's 5 or 5.5 million per person. So, you can't have more exposure, and if that 5.5 million carries across brands, so you can't do 5.5 in this brand A and then another 5.5 in brand B.
And this is another thing, don't hold me to this, folks that are listening, is I think there's even an exemption to if you have a net worth below 100 million or something, there's a way to get up to, I think, 12 to 15 million of SBA if some of your businesses are providing I want to say it's like either green initiatives or some sort of community efforts. Like for our laundromats, for example, our washers and dryers were energy efficient, so our franchisees were able to borrow more than the initial 5 million. So check that out too if you're listening. If certain concepts or businesses you're looking at, they might qualify for some of those exemptions, and you could borrow more than the 5 million cap from the SBA. But again, don't hold me exactly to that, but check it out. Okay, so you'll use the SBA for smaller deals. You'll start to use private capital and other, or as well as other banking options for some of the larger deals. Could you give us like a use case of one of the larger deals of like, hey, I try to structure it this way. It's 10% cash down on my end, then I'm borrowing 40%, and then it's private equity or private capital in for the other 50, and here's how I structure it. It's over 3 years. And we don't have to get into exact details, but just a hypothetical scenario for someone listening to, I think, better understand how you would think about putting a deal of that size and that complexity together.
Yeah, so hypothetically, let's just say that I'm buying 20 locations. EBITDA is like 3 million bucks. Okay. Let's just say it's trading at the transaction. Let's just make it easy. The transaction is 20 million bucks, right?
Yep.
And let's just say that the cash flow again is 3 million, and let's just say EBITDA equals cash flow. Okay.
Yep.
So in that case, I need to find 20 million bucks, probably like 22, so that we have working capital on balance sheet. So out of the 22 million, I'm looking to generally put in 20% of the equity, right? So
Yep.
close to 7 million bucks, right? Maybe 6.5, 7 million bucks. So out of that, I'm either writing that check myself or I'm syndicating out some of that equity so I can raise it. But in the meantime, as I'm going through that capital raising, I need to find the additional $16 million, right? So if once I go to, I have a debt lender broker that whenever I need to get a deal done, he gets it done for me. But he's syndicating out to all these banks that have interest in this particular brand or this particular sector. And he or the direct relationships I have with certain banks, I'll go to and say, hey, do you have any interest? And for example, like there are banks out there, like for Dave's Hot Chicken, for example. I mean, there are 5 to 7 banks that are aggressively looking to get more exposure into Dave's Hot Chicken, right? And I could say the same thing about European Wax Center or Orange Theory, that there were multiple banks that wanted exposure. And so the underwriting process, if you go to one of those banks, is much easier than say you go to your local community bank that doesn't know anything about the brand, right?
Yep.
So to get the extra slug, I mean, you'd go to the preferred lenders first, and then number two, you'd go to other middle market lenders who, may take a little bit longer on the underwriting process.
And so you'll finance 20% equity, whether it's syndicated, your own check, it's said partners, et cetera. The other 80%, debt financing from one of the banks. What do the terms typically look like on, non-SBA bank loan like that? Is it, the current market interest rate over a 10-year period? Is it 5 years? What are the, I guess, again, hypothetical scenarios you typically see?
Yeah, it varies all across. I mean, you have debt that's interest only for 5 years. You have debt that's and the interest can be like SOFR plus 4 or 5%. And so generally the effective rate of loans right now in July of 2025 is somewhere around 8 to 10.5%. And then you're playing around with amortization. Sometimes the debt will expire and you have to refinance in 5 years, but the amortization will be 10. So there's a lot of different, and some, middle market lenders, not the small ones, but the middle market folks will allow you to pick the interest, right? So you can pay in kind. So the debt increases over time. And you're basically paying interest with more principal. You're increasing the principal. So there's so many different types of, options that you can kind of pull, but usually the more sophisticated options, like I'm saying with like pick interest, that happens with the middle market lenders. That's not happening in the SBA. The SBA is going to be very, very rigid on how they kind of view it. But the SBA will give you some time for construction periods or, an interest only period, even on acquisitions. They have a few levers, but the more levers come when you have like bigger loan amounts.
Yep. And so it really is like you're using all these different tools in your tool belt. It depends on the deal, the brand, the market, a lot of different factors before you decide one path or the other. Have you ever leveraged like private debt to finance any of these deals instead of it being equity? You go to groups of family offices or other groups and say, "Hey, I need to borrow 10 million and I'll give you, or a couple million and I'll give you just a set interest rate that could move faster than a bank, maybe."
I have not. I've used family offices more on the equity side, or yeah, and but I've not used a debt vehicle on the private side yet. But I mean, I know a lot of folks that do that, um, and it could be very attractive because their speed to market is fast, and they can underwrite the deals much quicker because they don't have huge committees.
Yeah. And sorry, one more question, because I think people will be curious about this, especially those going from, a few single units to starting to go bigger and, raising larger capital like this. What's your target like ownership percentage? Let's say you're about to buy 10 units of something and you wanted to use the hypothetical we just walked through of 20% equity, the rest financed via a term loan. What kind of equity ownership target would you have for yourself for structuring this deal, ultimately operating the business, going out and raising the capital, running it, et cetera? What is market, or what do you think is fair or a good deal for, the operator, the owner in that example?
Yeah, I don't know that I'm market, but I for me to be excited about something, I need to have at least 30%. That's the bare minimum for me to own, and I go upwards. In a syndicated deal, I go upwards of 55.
Okay.
Um, but it's also very important that whoever's invested in me gets a solid return. So I want to make sure that the model, even in the mid case, provides a great double at a minimum double-digit returns. So that I'm cognizant of both, but I have to make sure that I'm excited about it every day.
Yep.
Otherwise, I don't. It's not worth my time.
And you were saying you might not be market. Are you on the higher end or the lower end, or what do you think market would look like
I,
on
I think
average?
I believe I'm on the higher end. I've seen people get better deals than mine, but I also have seen folks kind of running the 2 and 20 model, the traditional private equity model. And I don't see how that works, especially when you're not at scale. Like if let's just say you're buying 10 crumble, or let's just say 5 crumbles and you're doing 2 and 20 model. I don't see how the economics work that well unless you have a great path for acquisitions or new de novos and you can get to 50 to 100, because the 2 and 20 model works really well when you can deploy large amounts of capital.
Mm-hmm. Interesting. And then I was going to ask, so when it is a situation where you own less than 50% of the business, is there ever any concern about control, or, could this person eventually say, "Hey, we're going to put a different operator in"? And is that a worry that you would have, or any advice on that topic?
Not yet. Um, I mean, could it happen? Yeah, certainly. But knock on wood, it hasn't happened. But we've also been performing, so that usually happens when performance has kind of gone sour.
But that is a risk, right? Like, I think for people that are, maybe again thinking about doing this for the first time, this is a way to go big and to get dozens and dozens of units open. But some of the risk is that you are working with other people and you might be giving up some of that control in exchange for speed and scale. Is that a fair thing for people to have to consider and think about?
Yeah, it's certainly fair, especially if you're, going with a like one family office and one private equity firm who owns the majority. That's a very real possibility, right? But if you have a syndicated group, a diversified group, that's a little bit harder to, have like a material event to kick the CEO out. Now, I think that all, operators should be very self-aware and saying, hey, if they're not the right person for the role, they should step down. But
Raise their hand. Yep.
yeah, yeah. So you owe that to your shareholders. That's your fiduciary duty.
Yep. Completely agree. I mean, that's why I think especially, and this is different, it's for venture capital and tech startups, but this idea of governance sometimes being a bad thing. It's like, I don't know. I think sure, sometimes you could be too early in the company's life cycle where it's like you just need to go fast and you don't want to be bogged down by some of the more kind of bureaucratic processes and conversations. But governance historically, if you look at all the data, has drastically improved performance and the success of a business for the exact reason you just said, is everyone has to have this fiduciary responsibility for the business, for the owners, for the investors, And if you're not the right operator at whatever stage in the business's life cycle, that's okay. It's part of the business evolving and growing, and either you grow with it or you have to level up, the team and keep the thing going because you still have a vested interest in it.
Yep.
I mean, that whole section on financing and how you think about structuring deals, I think is incredibly helpful. Um, there's another side of that coin of this is all assuming that you're able to even get into these brands, right? Some brands are so hard, they're so sought after. There's a lot of smart capital and operators gunning for them. I'd love to get your take on, on that side of the coin of, when you do look for this new up and coming hot concept that is going to sell out. I mean, are you pitching the brand as much as they're pitching you? And I guess how do you position yourself? I know now with the track record you have, but in the earlier days when you're maybe getting into Dave's or some of these other concepts that are taking off, and you were still sub 5 years into building this portfolio out, how did you position yourself, and what does that process look like?
Yeah, Alex, I'm still pitching myself. So, when we got into Orange Theory, it was tough. That was our first brand, so rightfully so, very very tough. European Wax Center was not easy. I went through a lot of questions of like why you're a fitness guy. I mean, that what it wasn't really. I was only in fitness for a month or a year, sorry. But I had to convince them that hey, I can take these 4 locations and turn them around, and I did so. But kind of fast forward to the food business, that was a little bit more challenging because now we're going into multi-unit, and I had to convince the Marcos folks that hey, I'm not just an office guy. I'll be in the field and getting with the managers and making sure that they're motivated and ready to go. But the hardest one was Dave's. Actually, Dave's and Pop Up were both extremely hard to get into. Dave's, went through a very long vetting process. So sometimes I talk to landlords because they're like, well, what happens if a new operator comes in and takes over, Cal's enterprise? We don't trust them. I said, hey guys, Dave's has an extraordinary vetting process. Like if someone's gonna, buy us out eventually, like you're in good hands. And then the pop up side, I mean, I had to, we signed it in December of 24. And I mean, I had to put together pitch decks. I had to, meet with the CEO in Vegas and then out in New York. And initially, we were only going to get a part of Florida, and we had to do the strong pitch to get, the majority of Florida. But now that the deal is done, I think both sides are extremely happy. And but I think it's just a process of, making sure that they are comfortable with you, especially with large territories, right? For pop up, we have 30 locations. So they're taking a big risk by giving that to one operator, right? And so they need to do their diligence, especially when they believe, which they do, have a really good brand. They want to protect it. And they should for themselves and also the other franchisees. And Dave's the same way. I mean, they have a very strong brand, and they got to make sure that they don't overcommit. And for Dave's, we only started with 10. Now, we're going to be upwards of 30. But, we started with 10, and we were grateful to get that. And as soon as, we opened our first, second stores, we showed them, hey, we have a team that's, maniacally focused on operations, and these are our views, and we pitched them again, and we got additional territory.
Yep. I think it brings up a good point of, or response to something we were talking about earlier, and that was, green and red flags when you're looking at a business. And I think another red flag could be when you're talking to a brand, if they have no questions about you, or they truly are just like almost giving away licenses without vetting you and, being very picky about what you do. That's probably another indicator of how serious they take themselves and what they're doing and how picky they are about the operators that they're partnering with and the franchisees that they're partnering with.
Yeah, absolutely. I mean, you want to be in a brand with really strong franchisees. I've been in brands with, neighbors, franchisees that are not really vetted, and that hurts, your local geography, the local brand geography, right? If brand A has a franchisee in, say, Boston, Massachusetts, but you're 10 miles out and Boston has a lot of new guest counts that are getting bad experiences, they're less likely to come to your location, right? So you want franchisees that are vetted and strong so that the whole brand rises.
Yeah, what's that saying? It's rising tides raise all boats, and
Oh,
it's no different here with the right operators and the right partners.
yeah. And if you have great franchisees and a great brand, franchisor, I mean, multiples go up. right? It's everyone has better exits, everyone has better cash flow, and the stronger the brand, the stronger the exit.
Hmm. Sorry, you just said something that reminded me when we were talking about structuring the deals, when you said cash flow and better exit. I forgot to ask this. It was when you do have an equity partner and you go to syndicate a deal like that, how are you typically splitting your profits? Is it, hey, if they own 60% and you own 40, they make 60% of cash flow each year after tax and you're 40%, or it's 60% on the exit, or is it structured, differently than that?
So generally speaking, actually with all my businesses, we don't do dividends.
Okay.
So our philosophy is spend somewhere between 4 and 7 years building a behemoth that's well oiled and operating really well, and eventually exit. And at that point, it's the waterfall dictates how people get paid, but it's generally based off of equity percentages. So we're not a dividend company. We're a high growth company.
So you plow every bit of cash flow back into the business, which is, I think, incredibly smart if growth is the game. And
But that's
then we're,
also how I'm incentivized, right? I'm incentivized off mostly off
enterprise value.
yeah.
Got it. Okay, so you'll, instead of, like, let's say we go to, in this again hypothetical, if it's 60-40 split, you go sell it for $100 million. If the target was 60 though, and you just surpassed it by 40, I imagine there's some sort of, incentive where you're not just getting paid the 40-60, you're getting your 40 plus some other premium because you hit a target number on top of
Yeah,
that.
you in all the brands I'm in, right? I have some baseline equity, and then I have a what's called a MIP, Management Incentive Program. And so that's based off of equity return to shareholders, and then based off of that, we can earn an additional 15%.
Very cool. That's really helpful to know. And I think this is some of the stuff that, again, people getting into this game at this size wouldn't maybe know about. So I appreciate you sharing even what a MIP is and how it's structured typically and what it looks like. I know we're coming up on time. I want to or we got 10 minutes or so. I want to make sure we get into some of the kind of like operating questions, and then also just advice that you'll have for other operators, as they think, going from single digit to greater. But let's talk about the org structure. When you go from 10 Daves to now 80 units across multiple brands. How do you think about your team? Is it the same infrastructure for all the different brands, or is each brand considered its own discrete, separate entity and has its own, functioning management team?
So over time, we've kind of created what's called a shared office model, right? So in the shared office, we have HR, we have finance, development, and a few and marketing. So those folks will be used amongst all the brands. So
Yep.
the hard part about that is we have to wear different hats, right? We could be talking about Dave's Hot Chicken in one sentence, but then the next conversation we talk about med spa, and like it's a complete it's a completely different marketing model, right? And so I need really highly talented people that can handle that. And that's not easy to find. But on the other side, to your question, was the operations are very bifurcated. So, we have a director for each brand. So Marco's has its own directors, two directors for different regions. Dave's has its own director of operations, and then Pop Up has its own director of operations. So, in our high growth brands, we have a director for each brand. But then, look, I just joined Hand and Stone Massage, and we have one location, and the manager and I are speaking directly every week. So it changes. So on the operation sides, we're a little bit more flexible, but the shared office space, which is the HR, the finance, the development, the marketing, they represent all the brands.
Interesting. I mean, it makes sense on the, like you said, shared services where payroll's payroll, or hiring, if it might be similar type of employees across different brands, but then keeping the nuanced functions separate. I mean, operating a Marcos, I imagine, is very different than a med spa, and keeping that separate is smart. Is there one mistake as you think about, as you scaled operations, because that can be, I think, what makes or breaks a company, especially as you scale. Is there one mistake that you made early on that you'd never make again from an operational perspective?
Yeah, I think when it comes to the brands that we're scaling fast, you always want to be overcapitalized so that you have what's called an NRO team. So what's called is a new restaurant opening team, right?
Okay.
And those, if you're, let's just say you're building 10 a year, which is aggressive, you need folks dedicated to new restaurants, like just dedicated to that. You could have a manager every location, which we do. You have a district manager overseeing anywhere from 3 to 7 locations. Yeah, that's got to be in place. But you have to have dedicated folks for new restaurant openings. Because what happens in restaurants is, we could stay there for 2 weeks, right? And really set the team up for success. But in week three, motivation may come down a little bit. But so you need those highly energetic folks that are highly trained to stay with the team for weeks. I mean, sometimes 6 weeks post opening to make sure that brand standards are being held, customer service, and it's natural. It's very human to get tired, right? You go through a grand opening, which is really tiresome. Really, I mean, it takes a lot to open a restaurant, especially at Dave's. And after a period of time, you're going to lose energy. That's just normal. But you need these folks to kind of keep the energy going. And you need to have enough people because the NRO team can get tired, right? So in order to maintain sales at a very high level, because a lot of restaurants open up huge and then drop drastically. If you have a great NRO team, you can stay high, right? Maybe come down a little bit, and then you have just a higher high versus kind of dropping down because the guest experience has been very poor.
And how big is your NRO team for the number of brands and the number of units that you're opening each year?
Yeah, so for Dave's, for example, we only have 3 stores open. We'll have 7 by the end of the year and 15 by the end of next year. We have 4 people above store, and then we have 2 dedicated people for NRO, and then we pull an additional 7 people we have another 7 people that we can pull from existing stores.
Wow. And so that's just for Dave's.
Yeah. Pop-up will likely have 3 people dedicated. But remember, we only have 1 location opening in August, and then we have 3 more opening up in November and December. So we have a little bit of time to build that, but not much.
Yeah. And so that team is purely dedicated new store opening, new restaurant opening.
Yeah. And guess what? That causes cash burn, right? It causes cash burn because you have above store costs. But I'd much rather have, 7 businesses doing 70,000 a week than 7 businesses doing 45 a week, and pay up for that. That's just, it's a no-brainer to me.
And that was the learning that you had along the way of, at first you tried to do things maybe more scrappy and lean, and now you're like, hey, nope, you pay for it in the long run by doing that.
Yeah. I mean, if you're building for enterprise value, it's all going to come down to sales, right? How much sales can you retain? And guess what? The consumer is not so forgiving as much as we want to think they are. They want great food, quality food, at a decent price, right? And if we don't provide that service, even in that first month or first days, they're likely not going to give you a second pass, right? So you really got to capture, because the great thing about restaurants is there's so much buzz about new restaurants, right? You get natural visibility and people want to try you, but you really have to capture your audience during that first weeks. And my team has I hope that's one thing that I imparted on them, but a really high sense of urgency, and we got to make sure that guest is taken care of on day one.
Yep. All right, just to start to wrap up with some of the more kind of advice-focused questions for people thinking about scaling, really, is there anything that you think people totally misunderstand or maybe take for granted when it comes to scaling in franchising specifically?
Yeah, I mean, in scaling, there's 2 options, right? There's acquisitions or de novos, but in both cases, you need to have a team to handle that. To scale from 1 to 15 units a year takes a lot of time and effort. And so if you really want to do that, you have to pre-invest in a team that might cause cash burn in the interim.
Mm-hmm. And what about someone who, might have a couple units open today? If they want to get to that size, doing 5 to 10 a year, what advice do you have for that group of people?
I just make sure that you have the capital needed to get there. Be okay with some burn, but you have to have the right people in the right place in order to handle it. And if you don't have your existing 1, 2, 3, 4 stores ready, and they're not running, like a well-oiled machine. These additional 5 to 10 stores on top of that are gonna really hurt your overall portfolio.
Hmm. And then last question I have is, you've done a mixture of food and the non-food concepts. Is there a sector or any brands that you see kind of up and coming that you're really excited about? Any categories or sectors? And I guess if so, brands within those sectors that you're really excited about.
Yeah, I mean, on the food side, I'm extraordinarily excited about Dave's and Pop Up, because those are, high growth brands, and the unit economics are stellar, or I believe them to be stellar. And in the non-food side, we're jumping into experiential, so I'm quite excited about that. Through a concept called Sandbox VR, we're opening our first location in 2 weeks. Yeah. So, I want to see how we operate in this new sector, and if we do, then we're going to double and triple down in experiential. And services. I think services are always strong, Amazon proof. Like we just entered the massage space, and massage is doing extraordinary if you pick the right brand.
There is, you just reminded me when you said indoor experiential. There's a brand, I want to say it's called Slick City, or have you heard of this?
Yeah, yeah. A buddy of mine bought the rights to, I believe, Orlando and Tampa. He's a Days franchisee, and he's wildly excited to get them open.
It looks, one just opened in, I think, Charlotte, and there's one open in Minneapolis where I'm from originally, and the numbers are crazy. I want to say it's like 5, 6 million in revenue, and EBITDA is 45%, and it looks fascinating.
Yeah, absolutely. But he's very excited, and I've seen the numbers, and I'm excited for him.
Yeah. Well, Cal, I know we're running up on time and you got another call to jump to, but I really appreciate you taking the last hour to share your story, share the advice on how you went from, two back in not that long ago, 2017, to 80 plus and 140, across all the different exposure. Truly, thank you for the advice, the time, and being willing to help others that are on their journey. So thanks for joining.
Yeah, thanks, Alex, for having me, and for the great discussion. Hopefully, it helps some viewers. But always looking forward to having great conversations with people in the franchise industry.
Yep. If there's any way to connect with you, is the best thing for people to do is follow you on LinkedIn and connect with you that way.
Yeah, I'm very active on LinkedIn, and you can go to my website, which is simpleventuresllc.com. But LinkedIn, I'm very active on.
Awesome. Cool. Well, appreciate it again, Cal, and we'll talk again soon.